This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Steve Saretsky here. First things first, I'm co-hosting a webinar next week to chat about the Vancouver housing market. If you have specific questions you want to come and ask me, come register for the webinar. There is a link in the description below where you can go and register for free and come ask me your questions about the Vancouver housing market. But let's start this week off with what everybody's talking about: Silicon Valley Bank going bust, going to zero, being taken over by the FDIC, the insurers basically coming out and bailing out all these depositors. It's the second largest banking failure in U.S. history, over $200 billion of assets at the time of their insolvency. And it was the 16th largest bank in the U.S. So certainly not insignificant. Again, I really must emphasize this is the second largest banking failure in the U.S. And so what I'm going to try to do in this episode is I'm going to try to basically explain this thing in simple terms and go over sort of the implications for what it means for Canadians, what it means potentially for the housing market, the mortgage market, the Bank of Canada. There's a lot of moving pieces here. This is a very fast developing story, but it's extremely, extremely important. So what I have to sort of start off with is the overarching theme of these videos and of this channel for the last 4, 5, 6 years has been, listen guys, central banks are basically the only game in town, right? Over the last decade, they've left interest rates at zero and they've run massive amounts, trillions of dollars worth of quantitative easing. And that, of course, suppressed bond yields, right? I mean, you could borrow a mortgage in Canada, right, for 2% for the last 5+ years. This obviously boosted asset prices. And so what you need to know basically here is now that interest rates have gone up by over 400 basis points in less than a year, the fastest rate hiking cycle adjusted for the debt loads in modern history, naturally something's going to eventually go boom in the night. And we saw some things rumbling around. You saw some issues in the UK pension system several months ago. We saw some insane volatility in the Japanese yen in that currency market. And now, of course, we're seeing the second largest financial banking crisis in the United States playing out right before our eyes. So it should come as no surprise that when you leave rates at zero for 10 years and you embark on a massive rate hiking cycle, that things are going to blow up. And so basically what's happened here is the Fed raised rates. These institutions haven't been able to basically pass on higher deposits on checking savings account because that erodes their profitability. And so what's happening is deposits are essentially leaving some of these institutions and they're going into money markets, mutual funds, short-term bonds, etc., looking for higher yield. And so these deposits are basically leaving. And so what these institutions are doing is they're going to have to try to either raise their deposits, which is going to again destroy their profitability, or they can sell off assets and basically raise capital. But the problem is that these banks are required to hold a proportionate amount of assets to offset their liabilities. So in Canada, we call it Tier 1 capital ratios. The banks, while they can create credit out of thin air, they must hold a certain amount of assets as per banking requirements. And so these banks typically hold what they deem as, safe, Tier 1 grade A assets, right? Government bonds, municipal debt, mortgage-backed securities, stuff that's government guaranteed, stuff, of course, that the Federal Reserve has been buying through massive amounts during the quantitative easing program. Of course, they're now running the reverse, doing quantitative tightening. And so what's happening is as interest rates go up, as the yields increase on these securities, the value declines. So it's the inverse relationship. So in order for these these institutions to basically raise capital. They'd have to sell, if they were to sell these assets, they would be materializing significant losses. And there's a great chart here which really shows if they were to mark to market across financial institutions, these banks would be looking at massive losses. And so they basically have this now liquidity crunch where they basically can't sell off these assets without materializing these large losses. And so they're in this very awkward predicament now where, again, the Federal Reserve and these central banks have kind of, we call them the fire and the arsonists. They're the arsonists in that they create the fire and then they have to come in with a hose later to put it back out. And so they've actually created this crisis themselves, again, by leaving rates too low for too long and having to jack up rates very, very quickly. It's created solvency issues, or at least liquidity issues, I should say, at these banks. And so I'd highly encourage you to go check out an interview by Christopher Wallen. He's a banking expert. He was interviewed on the Blockworks podcast. But let's clip to Chris's comments right here.
Yeah, if the Fed doesn't react quickly, I think you're going to continue to see institutions subject to liquidity runs. You may see another bank fail today. And I think that the Fed needs to change the narrative very quickly, and they're going to have to eat some crow. I think Chair Powell has to get up in front of the cameras and say, look, quantitative easing, to the extent we did it, was a mistake. And now we have to dig our way out. And I think the Fed has to accommodate depositories. They have to accommodate other investors as they adjust. Because we can't just go raise equity. I mean, there's not enough equity out there to raise. They're going to need help and time. We need to buy time for these banks to work this stuff out.
So Chris is basically arguing that the next move for the Fed is going to be to come out Monday to reassure markets, and he believes they need to cut interest rates. Again, whether or not that happens, I'm not advocating for it. I'm not saying it's going to happen, but this is a banking expert. I am not a banking expert. I am simply sharing, what I think to be relevant and interesting information. And so it's very, very ironic that, again, as the Fed tries to fight inflation, that they've created the crisis, which now could require them, I think, ultimately to cut rates with a very, very sharp turn of direction. But we all knew this was going to happen. At some point, something was going to break. At some point, you simply cannot embark on the fastest rate hiking cycle on a highly levered, the most indebted global economy that we've ever seen, and not expect something to blow up. And so it's now concerning that you could have more knock-on effects, more banks under pressure. And so we're going to see how this gets resolved, and it might not get resolved in a week, it might not get resolved in several months. As we remember back in 2007, 2008, the first bank to go under was actually in 2007. People sort of dismissed it, and of course it morphed into something a little bit larger in 2008. So this kind of brings me home to some recent things here that we're seeing in Canada. Of course, the Bank of Canada prior to this had hit the pause button this week. We already kind of knew that was going to happen, but the reality is the Bank of Canada, let's make no mistake, they've sacrificed the loonie, the Canadian dollar, for the housing market. The housing market is such a large component, and real estate is the asset that underpins the banking system. Your house is the bank's asset, not yours. That's the bank's collateral. So if you're asking me, people are saying, well, this isn't fair, Steve. I don't understand. How can the banks be allowed to defer basically all these people that are on these fixed payment variable rate mortgages? How come they're allowed to allow them to have 20, 35, 45, 50-year amortizations? How come they're not increasing people's payments? It's because the banks aren't stupid. This is the banks. The banks want to control the housing market. The banks don't want a fire sale. The banks don't want thousands of houses coming to the market, flooding it and crushing the value and basically eroding their capital base. And so this is similar to what these banks are dealing with in the U.S., just with government bonds and various securities that are ultimately essentially backstopped by the government. So again, what you need to know is the collateral in the system is what keeps the banks going, and the collateral in the system is being impaired by these
the massive surge in interest rates. And so it was really only a matter of time. And getting to more data, we're looking at the Canadian jobs numbers, of course, coming out this week. 22,000 jobs versus the estimated 10,000 jobs. The sixth straight month of job growth, beating expectations. But when you see things like this, you're like, it doesn't quite square. Okay, so we've got interest rates going up, banks going kaboom in the night. I can tell you what's happening on the commercial real estate side of things. Things are happening underneath the surface, as one would expect. You've got lots of stress happening in the office market. You've got a lot of land developers, which we've talked about in this show, are now under stress, going into foreclosure. Big sites, developments are being paused, and when 8% of your labor force just in Canada is employed just in the construction sector alone, not including realtors, mortgage brokers, real estate lawyers, etc. When that sector comes under pressure, don't worry about the lagging jobs numbers. I guarantee you'll see the layoffs. They are coming, but it takes time to filter through the system. And it is coming. The commercial real estate sector is such a large component of Canada's economy, of the labor force. People always say, well, what does Vancouver do? We don't have, massive global companies here, big tech companies that have headquarters here. What do? We build and sell real estate to the rest of the world. And so if that sector comes under stress, I can guarantee you'll see job losses. So stop looking at, Stats Canada's, surveys that they're doing about the jobs market. It's coming. But it takes time. Foreclosures don't happen overnight. It's coming. I can tell you, because I have these conversations with people in the industry on a weekly basis. And so just like we knew it was coming with we didn't know the specific bank, but we knew something was going to go. We didn't know what it was, but something was going to go. And it turned out to be Silicon Valley Bank. So this is something that we'll continue to watch. I'm sure we'll expand on it in the Loonie Hour next week. But this is not something that's going to resolve itself overnight. This is just the sort of first domino that I think definitely bears watching moving forward. And of course, if you're looking at it from the mortgage side, we saw a big sell-off in your Canada 5-year bond yield. Of course, people rushing to safety, pushing down government bond yields, looking for this sort of safe haven, and so bond yields have been falling, and so this could be, we're gonna have to wait and see how this plays out. It's very hard to predict, but there's a lot of moving pieces that are happening right now behind the scenes. So hope that helped. As always, highly encourage you to go check out Christopher Wallen on the Blockworks Forward Guidance podcast. A very important listen. So see you next week.